Dr. Poole, as promised, I'm going to give you time to respond to what Dr. Meyer had said with regard to kind of a de facto dual mandate standard among central banks around the world. Care to respond?
No, I think that's correct. But one thing that he did say along the way is that there is, I think he used the word hierarchy in the employment and price mandate or objective. And the reason that you've got that hierarchy is that once we lose price stability, then we also lose employment stability, and the central bank also loses the flexibility to respond to the real economy, to the employment situation. A very good example is what happened in the late 1970s. As the markets lost confidence in the Federal Reserve because the Federal Reserve kept feeding money into an inflationary economy, kept saying it was going to bring inflation down, inflation kept rising. At that point, the Federal Reserve also lost, I'll say, power to have a constructive influence on unemployment. And so when Paul Volcker came into office, he understood that the first thing he had to do was to restore Federal Reserve credibility, because that was important both for the inflation objective but also for the employment objective.
Is it your assessment that Chairman Volcker did restore that credibility, that he succeeded in doing that?
Oh, absolutely.
How would you compare the credibility of the Federal Reserve under the leadership of Chairman Volcker to the credibility of the Federal Reserve today?
My sense of the history here would be that it took a little while for the markets to have really a very high degree of confidence in the Federal Reserve. Volcker hung on through a difficult recession that took the unemployment rate to, what, 10.6%? He had the support of President Reagan, and over time, with the success of that policy, the Federal Reserve position grew stronger. Market credibility improved. And that continued to strengthen through the tenure of Chairman Greenspan. I believe that the market still has a very high degree of regard, very high regard for Chairman Bernanke, but I believe it is not as solidly entrenched as it was under Greenspan. That is, it would be easier for there to be a policy mistake and for inflation expectations to take hold.
Thank you. Dr. Taylor, based on the rate at which Congress is spending, the rate at which Congress is engaging in deficit spending, and based on where you see U.S. Treasury yield rates going in the next few years, do you have any predictions, or do you have an ability to predict how long it might be between now and the time that we can expect to be paying $1 trillion a year in interest on our national debt?
Well, it's very hard to forecast when rates are going up, but they're going up. And probably more than on the forecast of CBO. There's certainly a risk of that, in which case the deficit will get worse. And I don't want to predict a particular date, but it's clear right now that unless policy changes, the debt is going to continue to rise as a share of GDP. Interest payments will grow rapidly as a share of the budget and, of course, as a share of GDP. And I don't see any change right now in that. Last time CBO made a forecast of the debt-to-GDP ratio long-term, which was last summer, and, of course, it skyrockets to hundreds of percent. The United States of America won't be the United States of America if that happens. So I think it's a great concern. This hearing is not on fiscal policy, but that's an extraordinarily important problem to fix. I mean, the relationship to the Fed is the extent that the Fed tends to monetize that debt. It becomes more of a problem down the road, and we need to be concerned about that. Of course, they say they want to undo it, and I hope they do. But in the meantime, they've set some precedents. So I think it's most important on the fiscal side is to adopt a budget which gradually reduces spending as a share of GDP. I recommend coming back to 2007 levels as a share of GDP. That's 19.5%, and really take this fiscal responsibility that the Congress and the President have and deal with it now.
Do you think it's plausible or reasonable to expect that Congress is likely to make significant cuts to bring the debt to GDP ratio down, bring our deficits down, as long as interest rates remain as low as they are now?
I think it's the right thing to do. It's really going to be the debate in this election year. You have a proposal from the House of Representatives, a budget which does that. You have a proposal from the President which doesn't do that. It's going to be part of the election. And as speaking objectively, not trying to predict the politics or predict the election, it is doable to fix this problem in a gradual, credible way. And I'm arguing for it all the time in other fora. So I can't predict, Senator, but I have a faith that when people see the numbers, when they see the charts, when they understand what's at stake, that the American people will respond.
Thank you.
I want to thank the members of the committee for being here today.